Hi, I'm Lindsey Bell with S&P Global Market Intelligence. S&P 500 fourth quarter earnings season is about 60% complete, yet earnings growth still remains deep in negative territory. In fact, the growth rate has only improved slightly in recent weeks. The current expectation is for a decline of 5.1% to $29. Growth is 44 basis points better than the estimate when earnings season kicked off in mid-January, but is just 15 basis points better than the estimates at the start of January. Historically, growth ends 400 to 450 basis points better than the start of the season, but given the current run rate, that type of beat is unlikely to occur in our opinion. That means this would be the second quarter in a row for the index to post a negative growth rate, an event that hasn't happened since 2009 when the economy was in a recession. With such a weak rate of improvement in fourth quarter earnings estimates and an underlying mixed economic environment, it's not surprising that corporate management teams are taking a conservative approach to their 2016 outlooks. 65% of companies have said they expect growth to be below the consensus estimate going forward. This is driving down analyst projections. At the start of the fourth quarter, on October 1st, they were much more optimistic, expecting mid-single-digit growth in the first half of the year and even double-digit growth in the second half. Those numbers steadily came down. Now both the first and second quarter of 2016 are slated to report earnings growth declines. Not surprisingly, downside to the numbers has primarily been driven by the energy and materials sectors. Information technology has seen the third largest reduction in numbers. We attribute a large part of that to the reduction in Apple's guidance and the ripple effect that has had on its suppliers. The trend to push out the bottom in S&P 500 earnings growth by a quarter has also continued. Instead of this quarter marking the bottom, Q1 2016 will now be the bottom. It will be interesting to see how long that trend continues. The good news is that weak growth rates in the second half of 2015 should bode well for stronger growth in the second half of 2016. Until next time, I'm Lindsey Bell with S&P Global Market Intelligence.